Now that earnings season is almost done, I am now able to post my monthly stocks that I think are looking undervalued video. In this video, I want to share 4 stocks I think are looking attractive in the market today and explain why. Before we get into this video though, I just quickly want to say thank you to all of my new Patreon members. Becoming a Patreon member is the #1 way to support my channel, and by doing so, you also gain access to a bunch of additional features, such as access to all of the stocks I am buying and selling, my personal portfolios, my Discord community, Patreon-only stock picks and stock analysis, and Patreon-only videos. So if you're interested in getting even more content from me and following along with my portfolios, then check out my Patreon in the link below. But with that being said, let's just hop right into the video. Alright, so the first stock that I want to talk about is KNSL, or Kinsale Capital Group Inc. Now, this is an insurance business that IPO'd in the market back in 2016, and since then, this stock is up a whopping 1900% or 19x. So this stock has almost 20x'd in about 8 years now, and it has massively outperformed the S&P 500, and the stock seems like it just loves to consistently go up and up and up. However, Kinsale recently reported its Q1 2024 earnings results, and the stock is now in a 30% correction from its all-time highs. So I quickly went through the earnings results, and they looked pretty dang good to me. So let's quickly take a look at Kinsale's financials here, and let's head over to its income statement and take a look at the revenue. And the revenue is currently at an all-time high of about $1.3 billion, and the revenue growth has been incredible for this business. Now, in the most recent quarter as well, the revenue came in at an all-time high of $354 million, so Kinsale's revenue is still growing and hitting all-time highs. Now, if we also take a look at its trailing 12 months net income, we can see that the earnings are at an all-time high of $351 million as well, and the earnings are clearly continuing to grow. So the overall fundamentals of this business look like they are continuing to grow and hit all-time highs. So then my question was, well, why is this stock selling off then, and why is it in a 30% correction from its all-time highs? And the reason is because the CEO, Michael Kehoe, during the company's earnings call, said that the longer-term growth rate for Kinsale would be more toward the 10 to 20% range. So this company has been historically growing its revenues at 40% annually over the past 8 years since being a public company. And in the most recent quarter, the CEO basically said that that 40% annual revenue growth rate cannot be sustained over the long term. And over the long term, investors should be expecting 10 to 20% growth. And this is why the stock sold off quite significantly. However, if we take a look at Kinsale's price to earnings ratio, it is trading for about 25.27 today. And if we take a look at its historical average since becoming a public company, it has been about 38.4. So Kinsale is selling well below its 8-year average historical price to earnings ratio. In fact, here in the stock market crash of 2020, it got down to a price to earnings ratio of 29.6. So the company is selling below where it was trading during the stock market crash of 2020. However, it is worth noting again that the CEO is projecting less future growth, and less future growth expectations does result in a lower price multiple for the business. However, Kinsale seems like a business that has a track record of executing extremely well, and it is still projecting 10 to 20% annual revenue growth over the longer term, and it is trading for a price to earnings ratio of about 25. So relative to the company's historical averages, the stock is looking arguably cheap, and relative to a 20% annual growth rate, a 25 price to earnings ratio is around fair value, if not on the cheaper end. Again, if the company can actually continue to compound its revenues and earnings at 20% annually. Now, another thing that I do like about this business is I was taking a look at the insider ownership here, and the CEO does own roughly 4% of the overall company, with a total market value of about $340 million now. The CFO also has about $23.5 million invested in the company, which is a large position for the CEO and the CFO. So the upper management over at Kinsale do seem like they are heavily incentivized to continue growing the business and overall growing the stock price. So I do think that the insiders of this business are aligned with creating shareholder value and the shareholders' best interests because they are large shareholders themselves. So ultimately, Kinsale does look like it is a high quality business that is currently in a 30% correction and selling for what seems to be a pretty fair or attractive price for a high quality business that is still projecting to grow its revenues at 20% annually. However, personally, I have not added Kinsale to my portfolios because the insurance industry is one that I believe is a little bit out of my circle of competence because I don't really understand the moats within the industry. For example, I don't know why Kinsale has an advantage over Intact Insurance or even Berkshire Hathaway's Geico. So I would need to understand the insurance industry a little bit more and have more conviction in Kinsale's overall moat before I took a position. But just based on the company's financials, its price today, and its historical execution, it is looking like an interesting stock in the month of May. All right, so now let's move on to the second stock that I want to talk about in this video, which is MELI or Mercado Libre. Now, MELI was actually featured in my April stocks to buy video, and since then the stock is up roughly 14%, and the company also reported its Q1 2024 earnings, and the earnings results, in my opinion, were pretty dang incredible. And since the business is continuing to grow very quickly and very well, and trade for what I believe is a low multiple relative to its growth, it is making it into my May stocks to buy video as well. So I quickly want to point out some highlights from the company's earnings report. So let's start off with right here. This says the net revenues and financial income of $4.3 billion, which is up 36% year over year. So MELI's Q1 revenue grew 36% year over year, which is an incredible growth rate. The company also had $40.7 billion of total payment volume, which was up 35% year over year, and $11.4 billion gross merchandise volume, which is up 20% year over year. Now, for those of you who may not know, MELI is Latin America's largest e-commerce and fintech platform. And the way that I like to describe MELI's business is it basically is the Amazon of South America. Now, moving on to the next screenshot here, this says Mercado's Pago's position continued to strengthen in Q1 24, with monthly active users reaching 49 million and growth accelerating to 38% year over year from 32% year over year in the fourth quarter of 2023. Assets under management also grew strongly at 90% year over year in the first quarter of 2024. We had another strong performance in our credit business in Q1 2024, with originations growing 71% year over year. And finally, in Q1 2024, we issued more than 1.5 million new credit cards in Brazil and Mexico, and credit card total payment volume grew 173% year over year. So I actually need to back up a little bit because MELI is very similar to Amazon's business, but MELI also does have a fintech segment of the business, which basically is like a credit company and overall just like a financial business for consumers. And their financial business is also growing extremely quickly, again with credit card payment volume up 173% year over year, assets under management up 90%, and the overall business growing extremely well. So it seems like all of the different business segments of MELI are growing at over 30% annually. Additionally, MELI does have an advertising business, and its advertising business is growing at 64% year over year. So just like how Amazon's advertising business is growing very quickly, so is MELI's, and MELI's is actually growing faster. So now let's take a quick look at MELI's financials right here. And we can see that its trailing 12 months revenue as of the first quarter is continuing to grow incredibly quickly. And this revenue growth is one of the most insane revenue growths that I have ever seen in a public company. So the business is continuing to grow very well. Now what's also interesting is MELI's operating cash flows are absolutely exploding right now as well. And in the trailing 12 months, it has hit $5.8 billion. Now, what I also really like about MELI is they do have low stock-based compensation, which you guys know on my channel I love to see, but the capital expenditures for the business are also quite low. In the trailing 12 months, the capex has been about $568 million, which is less than 10% of the overall operating cash flow. And what this means is that over 90% of MELI's operating cash flow becomes free cash flow for the business. And as we can see here, they have produced about $5.2 billion in trailing 12 months free cash flow now. And the free cash flow is hitting all-time highs. So this business is growing incredibly well, and now its profitability is also exploding, and it is producing billions of dollars in free cash flow. Now what's also interesting is MELI is only trading for a price to operating cash flow of about 14.8 right now, which is actually well below Amazon's price to operating cash flow of about 19, which we are going to take a look at later on in the video. And in my opinion, a 15 price to operating cash flow for a business that is consistently growing its revenues at 30% annually seems like a pretty dang cheap price. Additionally, MELI's long-term average price to operating cash flow is 47.2, so it's trading well below its historical averages. And the lowest it ever traded for was 12.3, so it's right near its historical lows in terms of its price to operating cash flows. In fact, back here in the Great Recession, MELI was trading for a price to operating cash flow of 17. So relative to this company's operating cash flows, it's actually cheaper than it was during the financial crisis, which is just kind of insane. So I don't know why this stock is trading for such a cheap price ratio right now, but if it can continue to compound its revenues and its cash flows at 30% annually, then this looks like a very, very low price. And honestly, I do wish that I bought the stock last month when I made my video, because it's already up 15% since then. And if the business's fundamentals can continue to compound this well, then I do think that the stock will continue to perform very well over the longer term. So this is definitely a stock that is on my own personal watch list. I don't own any shares yet, but it is definitely one of the stocks that I want to research more, and it is at the top of my watch list for stocks that I am considering to buy in my own portfolios right now. And for those reasons, I really wanted to share it again in this video. Now let's move on to the third stock that I want to talk about in this video, which is BN, or Brookfield Corporation. And I imagine that this is not a surprise to anyone who watches my channel. Brookfield just reported its earnings this week, and I made a full dedicated video to going through Brookfield's earnings, so I'm not going to really discuss the most recent results again in this video. And if you want a full update on how this business is performing in its growth and its price today, then I would recommend watching my most recent video on my channel. So in this video, what I'm going to do is provide business updates to Brookfield Corporation and some things that I don't think a lot of people are really talking about right now. And the first business update that I want to bring to your attention is actually an interview from Mark Zuckerberg, believe it or not. So let's watch this quick interview from Mark Zuckerberg, and then we will discuss the key points that he is saying afterwards.
Over the last few years, I think there's this issue of GPU production.
Yeah.
Right. So even companies that had the money to pay for the GPUs couldn't necessarily get as many as they wanted because there were all these supply constraints.
Yeah.
Now I think that's sort of getting less. So now I think you're seeing a bunch of companies think about, wow, we should just like really invest a lot of money in building out these things. And I think that will go for some period of time. There is a capital question of like, okay, at what point does it stop being worth it to put the capital in? But I actually think before we hit that, you're going to run into energy constraints, right? Because I don't think anyone's built a gigawatt single training cluster yet. I mean, just to, I guess, put this in perspective, I think a gigawatt, it's like around the size of like a meaningful nuclear power plant only going towards training a model. And then you run into these things that just end up being slower in the world. Like getting energy permitted is like a very heavily regulated government function. And if you're talking about building large new power plants or large build outs and then building transmission lines that cross other private or public land, that is just a heavily regulated thing. So you're talking about many years of lead time. So if we wanted to stand up just some like massive facility to power that, I think that's a very long-term project. I think we would probably build out bigger clusters than we currently can if we could get the energy to do it.
All right, so the key points that Mark Zuckerberg said in this video is that the number one constraint for AI development right now is actually energy consumption. So these massive businesses like Amazon, Google, Microsoft, and Meta, their number one constraint to continuing to develop their AI and grow their AI capabilities is actually just getting more energy infrastructure to power their data centers, which I don't think a lot of people are really talking about right now. Mark also says that it's very difficult and expensive to get the electricity needs to power these massive data centers, and simply no one is really doing it yet because of how expensive and regulated the energy industry is. He even said in this interview that Meta would be building and investing in larger data centers if they could secure the energy to do it. Now, why this is so interesting for Brookfield Corporation is because Brookfield owns Brookfield Renewables, or it has a large position in Brookfield Renewables, which is one of the largest renewable energy companies in the world. And just recently, Brookfield Renewables announced a 10.5 gigawatt deal with Microsoft to help Microsoft build out its AI capabilities and provide Microsoft with a significant amount of clean energy to power its data centers and its overall AI going forward. In this press release, Brookfield Renewables CEO also says, this first of its kind agreement, which is almost 8 times larger than the largest single corporate PPA ever signed, is a testament to our ability to reliably deliver clean power solutions at scale to corporate partners and accelerate their energy transition. So this 10.5 gigawatt clean power agreement with Microsoft is 8 times larger than the previous largest clean power agreement with a corporate client. So this is a massive thing for Brookfield's overall business. And as these AI companies want to continue building out their AI infrastructure, they're going to want clean, renewable power. And Brookfield is one of the only companies in the world that can provide clean power and renewable power at this scale. In the 2023 letter to shareholders, Bruce Flatt, who is Brookfield's CEO, also wrote this. Demand for cloud computing from digitalization and the adoption of AI-enabled tools is incentivizing these companies to continue investing heavily in their capabilities and capacity. We believe most investors have yet to grasp that there has been an equivalent surge in the need for data centers and securing an energy source required to power them. We have the ability to leverage Brookfield's ecosystem to provide turnkey solutions that include renewable power connectivity. Their consumption has grown by about 50% annually in recent years, making them the largest and fastest growing consumers of green power worldwide. So Bruce Flatt is basically saying here that Brookfield is aligned with the largest and fastest growing tech companies in the world. And he wrote this letter before the Microsoft deal was actually signed. So it's very clear that Brookfield is one of the only companies, again, that can provide renewable power at the scale that these large tech companies need. And since overall energy capacity is literally the limiting factor behind AI development right now, I do believe that Microsoft, Google, Amazon, and Meta are going to continue investing tens of billions of dollars into increasing their overall energy capacity and renewable power in general. And Brookfield, I do believe, is going to benefit massively from this over the longer term. So for those reasons, I do think that Brookfield's business is set up to benefit massively over the long term. And this is just one segment of the business that I do think will continue to perform well and grow its fundamentals literally over the decades to come. Brookfield is just an incredible business, in my opinion, and that is why it is the largest position in my portfolio. And in my Brookfield earnings video, I did highlight that this business is trading for about 12 times free cash flows right now, and it is projected to grow its free cash flows at 20% annually over the next 5 years. So a 12 price ratio for 20% annual growth, I do think is very attractive, and for those reasons, I do still think that Brookfield Corporation is undervalued in the market today. All right, now let's move on to the fourth and final stock that I want to talk about in this video, which is Amazon. I do still believe that Amazon is arguably undervalued in the market because the company's fundamentals are continuing to grow extremely well, and they are projecting strong growth for the remainder of 2024. Now, additionally, I found this screenshot right here provided by Quarter, which shows the advertising revenue growth of YouTube, Amazon, Meta, and Google. And as I have said on my channel before, Amazon's advertising business is growing incredibly well, and it is actually seeming like it is taking market share because its growth rates are well above Meta, YouTube, and Google. So right here, we can see that in the first quarter of 2021, Amazon's advertising business brought in $6.4 billion in revenue. And 3 years later, in the first quarter of 2024, the revenue almost doubled to $12 billion. Now, if we compare this to YouTube, YouTube brought in $6 billion in the first quarter of 2021, and it's grown about 50% to $8 billion now. So we can see that Amazon's advertising revenue is growing significantly faster than YouTube. In fact, the business has a 23% 3-year compounded annual growth rate, which is the fastest by far out of YouTube, Meta, Google, and Amazon. So Amazon's advertising business is growing incredibly well. And one thing that I don't see a lot of people talking about is Amazon has a reported 60% operating margin on its advertising revenue. So this revenue is very profitable, and it's even more profitable than AWS. It's also growing faster than AWS. So as Amazon's advertising business continues to grow and make up more of Amazon's overall business, its operating margins and overall cash flow margins should continue to improve, and this business can become an absolute monster for Amazon over the longer term, in my opinion. I also found this image on Twitter, which shows that AWS's growth is reaccelerating, and it is now at 17% year-over-year growth from its bottom of 12% year-over-year growth in the second quarter of 2023. So AWS's growth is also reaccelerating right now, and this is a very profitable portion of Amazon's overall business. So as AWS continues to grow, I also believe that Amazon's overall margins, its profit margins, and its overall profits are going to continue to uptrend and grow over the long term. This last screenshot right here is provided by FinChat, and it shows the overall AWS revenue and operating income. And we can see that in the trailing 12 months, AWS has now produced $94 billion in revenue and $29 billion in operating income. And their growth is definitely picking up once again. So as this trend continues, as I've said, I do believe that Amazon's overall business, fundamentals, and profits will continue to grow. In fact, if we head over to Amazon's cash flow statement, we can see that its operating cash flows are absolutely continuing to explode. And in the trailing 12 months now, it has produced $99.15 billion in operating cash flows, which is an all-time high for the company. If we also take a look at its operating cash flow margin, we can see that it is spiking, and it's now at 17%. And again, as the advertising business and as AWS continues to grow and make up more of Amazon's overall business, I do expect these profit margins to continue uptrending over the longer term and becoming a more profitable business. Now, lastly, we can see that Amazon's price to operating cash flow today is about 19.7. which is well below the company's 10-year historical average of about 27.6. So Amazon is trading for well below its historical average price to operating cash flow ratio, which is the best ratio that I've found to value Amazon's business off of. So the business doesn't look like it is trading for that expensive relative to the amount of profits that it actually produces, and it is trading near the low end of its historical range and well below its historical averages. And for that reason, I do not think that Amazon's business is looking expensive in the market today. And out of the Magnificent Seven, this is the stock that I would be the most comfortable buying today. And for those reasons, Amazon is also one of the largest positions in my own personal portfolios. And I am planning on continuing to hold this one for the extremely long term, as I do think it is one of the best businesses in the world. And it may even have one of the strongest moats in the world as well. So for all of those reasons, Amazon is making it into my May stocks that are looking undervalued video once again, because the business's price ratios are still near those record lows. So those are the 4 stocks that I think are looking attractive and undervalued in the market right now. And again, if you do want to support my content further and my channel further, then consider becoming a Patreon member and you will get even more content from me and all of those additional features and benefits that I discussed at the beginning of the video. But with that being said, that is going to wrap up the video for today, everyone. So thank you so much for watching. I truly hope that you enjoyed the video. And if you did, then please remember to leave a like on it because it really helps out. And if you want to see more content like this, then please consider subscribing to my channel as well. But again, that's going to wrap up the video for today, everyone. So I hope that you're all having a great weekend, and I hope to see you all again in my next video.